Hey guys, it's Akeem here, welcome back to the channel, and in today's video we're going to be looking into Disney stock, taking a look at their Q4 2021 results. And when they published their results, the stock actually jumped by 6%, which is pretty good for a company of this size. But then following that, you can see that it effectively gave away all of those gains, or most of them anyway, and ended the week up just 1.5%. When we flick across to the yearly chart, however, we can see that the stock is down as much as 20%. So naturally people are asking the question, considering the fact that the financial performance of the business is picking up once again, the revenues from their theme parks have increased substantially compared with a year ago, and we'll get into that shortly, but effectively the revenues increased by 100% from their theme parks. Does this now present a buying opportunity for the business? So in order to determine that, we're going to look at the income statement, we're going to look at the balance sheets, we're going to look at the cash flows, and then we're going to flick across to my personal valuation, which will give us an idea of the potential return on our investment if we buy the stock today at $150, if we believe that my inputs to my model are correct. Without further ado, let's just get into the video. So the first thing that I want to do is take you to the high level numbers of the income statement to get an overall picture of the business. So we can see here that revenues increased by 34% from $16.2 billion to $21.8 billion, which is absolutely massive for a business like Disney. You're not expecting revenue growth of 34% in a company like Disney. So we're going to need to dig into the detail to understand what's driving that revenue growth and whether we can expect that kind of revenue growth going forward, or is that a massive revenue growth simply because effectively their theme parks and so on were shut a year ago, and as a result of that they had fairly easy comparables. We'll dig into that detail shortly. We come across to their costs and expenses and we can see that they increased from $16 billion to $19.6 billion, which is an increase of around 25%. So their revenues have increased by 34%, their costs have increased by 25%. That is a good sign to see. That means that their margins are increasing and the company is becoming more profitable. They then don't have too many sort of weird or one-off expenses, which always makes our life a little bit easier, right? So they've got some restructuring and impairment charges in the year earlier of $113 million. Now, they don't have that in the current year. Effectively, what would have happened is that because of COVID, they would have had to make some restructuring changes within the business, and of course that comes at a cost. $113 million, I can't get too excited about that, right? I don't particularly care when they're generating revenues of $16.2 billion. They do have some other expenses of $436 million, which they didn't have a year earlier, so we'll look into what that is all about. Then they have some interest expenses of $311 million, which is effectively what they had in the prior year as well. So not concerned there. That gets us down to an income from continuing operations of $1.7 billion. You compare that with a year ago of just $46 million. Now that is a absolutely massive increase, right? So that's obviously good to see. The business is moving in the right direction. Of course, you've got to give your fair share to the taxman. So then we come down to a net income of $1.2 billion for the quarter, compared with just $30 million the year earlier. So that's very good to see. $1.2 billion for the quarter. So it gives you a rough idea of the profitability of this business. $1.2 billion for one quarter. We might be looking at somewhere in the region of $4.8 billion for the entire year. Of course, that's not going to be accurate, right? Because for a business like Disney, it's clearly very seasonal. And so their profits aren't earned evenly across the year. But these are the kind of initial calculations that I'm doing in my head just as I'm running through the business. So I'm thinking about the fact that the business is $272 billion company. It's generated $1.2 billion in the latest quarter. If we do think that it's going to be around $5 to $6 billion of net income for the year, then that's quite a high PE multiple. But like I said, the business is going under a number of changes and it's very seasonal. So we need to get further into the detail to see whether that's an accurate representation or not. So then I want to take you a little bit further into the detail of that income statement. So you can see out of that $21.8 billion of revenue, $14.5 billion of that came from Disney Media and Entertainment Distribution, and then we've got a further $7.2 billion coming from the Disney Parks Experiences and Products. Now look at this, right? They've seen 100% revenue growth on that segment, so on the Disney Parks Experiences and Products, which is absolutely fantastic. Clearly that is a good indicator that the business is getting back to normality. They also saw respectable growth in their Disney Media segment, which increased by 15%. So clearly that's very good as well. And we'll see that Disney Plus is driving a lot of that. So their subscriber numbers for Disney Plus actually beat expectations, which obviously is always good to see. With that being said, the revenue numbers aren't what's interesting here. When we come down to operating income from those segments, we can see that Disney Media and Entertainment Distribution only contributed $808 million. And you compare that to Disney Parks Experiences and Products, which contributed $2.4 billion. Well, then that's quite a discrepancy, right? So we've seen $14.5 billion in revenue, but that is only generating them $808 million. We come down to the Disney Parks and that is way more profitable, looking at operating margins there of around 30%. Not only that, but their operating income from Disney Media and Entertainment Distribution actually fell significantly. So despite the fact that they generated 15% more revenue, their operating income actually fell by 44%. So that's quite concerning and definitely something that we need to look into. So then when we dive even further into that $808 million of profit or operating income that they saw from their Disney Media and Entertainment distribution, we can see that their linear networks decreased by 13%, direct-to-consumer decreased by 27%, so the loss increased by 27%, which is never a good thing, and we'll come on to that in a moment. And then their content sales and licensing went from a profit to a loss as well. So overall, all of the segments within that subsegment is not doing well at all. But the one thing that I want to draw your attention to here is direct-to-consumer, because that is Disney Plus, and we're seeing that the losses on Disney Plus are actually increasing, despite the fact that their subscriber numbers are increasing. And management have provided us with some pretty good explanations for that. So we can see here that direct-to-consumer revenues for the quarter increased 34% to $4.7 billion, and operating loss increased 27% to $0.6 billion. The increase in operating loss was due to high losses at Disney Plus and to a lesser extent ESPN Plus, partially offset by improved results at Hulu. Okay, fine, so Disney Plus is creating a larger loss than it was previously, and considering the fact that it's a high growth segment, growing its revenues at 34%, maybe we can give it a pass. But what the management actually say is the reason for those increased losses. So we can see here that lower results at Disney Plus reflected higher programming and production, marketing and technology costs, partially offset by an increase in subscription revenue. Higher subscription revenue was due to subscriber growth and increases in retail pricing. So the good thing about this is that Disney Plus are actually able to increase their prices whilst increasing their subscriber numbers. So that shows that they've got pricing power, which in an era of high inflation is definitely something that you want to look for in any business. And in terms of the higher losses that they're generating, well, it's because they're creating more content. So we can see here higher programming and production, marketing and technology costs. So they are pumping a lot of money into Disney Plus, and as a result of that, the losses are actually increasing. I don't have a problem with that. They're making investments today to try and improve the business 5-10 years from now, and that is perfectly fine. And for a business like Disney, that is what they should be looking to do. Now, in terms of those total subscriber numbers, they actually grew by 37% year over year, from 95 million to 130 million. Now, I think management have a target, a long-term target between 2025 and 2026 of somewhere in the region of around 220 million users. So clearly they're not expecting growth to continue at 37% year over year, but there's something like a 20% compounded annual growth rate, which is pretty good and would put them in line with sort of Netflix's subscriber users today. And do I think that they can achieve that? I would say probably, right? Disney have a great brand. I don't particularly personally think that Disney Plus is all that good, if I'm being honest, but I think that their brand will actually carry them further. If I had to say, I think that Netflix have better content than Disney, but considering that Disney have a better brand than Netflix, I think that that will help to carry them and effectively grow their subscriber base. I then want to bring you down to the cash flow statement to see out of that $1.2 billion in net income, how much of that was actually cash flowing through the business. Because we all know that net income can be distorted due to accounting standards, right? So they've got $1.2 billion in net income. They make all of the relevant adjustments for non-cash expenses. And then we arrive at cash provided by operations of a negative $209 million. So despite the fact that the company is profitable, in the most recent quarter, actually cash is flowing out of the business, which is not what we want to see. And that's just cash from operations, right? That's not free cash flow. So negative $209 million here. They then made some investments through capital expenditure of around $1 billion. We're looking at around a loss or a cash outflow of $1.2 billion for the quarter. So this is a business that you would want to be cash flow generative, considering how mature it is. But despite that, this company is burning through cash, not only for the current quarter, but also for the previous quarter as well, where their cash outflows were around $700 million. They then used around $280 million in financing activities, and that brought us down to a total cash used, effectively a change in cash of $1.5 billion. So as I say, the company is burning through cash at the moment, which maybe is not that surprising considering they're investing heavily in Disney Plus. And not only that, actually their theme parks still haven't quite arrived at their pre-pandemic numbers yet. So considering that cash burn, of course, it's very important to look at the balance sheet and see how much cash they actually have. Are they going to need to issue new shares or raise new debt as a result of that? Now, considering that this is a $270 billion company, I don't think that anybody thinks that the business is going anywhere anytime soon, but it's definitely something that you want to keep an eye on. So we can see here that cash and cash equivalents of $14.4 billion, and then we compare that with the total debt. So the current portion of borrowings or debt here is $6.7 billion, so that is due within the next year. And then we can see here that they've got borrowings of, or long-term debt of $47 billion, so a total of around $53 billion in debt. Now, considering the fact that they've only got $14 billion in cash, some people might think, well, that's quite a lot of debt. In reality, it's not, because we can see here that their interest expenses are around $311 million for the quarter. If you multiply that by 4, you're looking at somewhere in the region of $1.2 billion of interest that they have to pay on that debt each and every year. They've got $14 billion of cash. Not only that, they will soon be cash flow generative. There's definitely no concerns from this business in terms of having to raise any capital anytime soon, unless they take on a significant project or make an acquisition or something like that. And then finally, the other thing that we wanted to know was what this other expense line item related to, because we saw an expense of $436 million in this year that wasn't there the year earlier. So naturally, we've got to be asking the question, does this mean that we're going to see this expense going through the P&L every year? And also, is it really an expense to the business? But when we dig further into the report, we can see that that $436 million loss is driven almost entirely by their loss on DraftKings. So Disney hold an investment in DraftKings, but because it's a small stake, what they have to do is they have to report the fair value of that investment each and every quarter. And because DraftKings share price has fallen significantly, so has the investment that Disney is holding in the business. And as a result of that, they have to post a loss to show that. It's the exact same story, although the opposite, of Amazon having to post their profits that they recorded on the Rivian investment. Now, I won't give too much weighting to this simply because it's an unrealized loss, in the same way that Amazon's Rivian investment was an unrealized gain. So then that brings me on to my valuation model for the business, which is a mix of a discounted cash flow and then an earnings multiple model. And then on top of that, I also look for a 2026 price target for the business using a multiple of EBITDA. Now, I won't run through all of the inputs to the model because, well, I don't want to bore you, but if you want to, you can pause the video. But some of the main ones here, we've got cash and cash equivalents of $14 billion, which we need to take into account. Total debt of $54 billion. They've got an enterprise value of $312 billion and a market capitalization of $272 billion. Now, in terms of shares outstanding have actually been increasing because Disney have been issuing shares over the last 5 years or so. And as a result of that, I was thinking that I was going to need to incorporate further share dilution into my model. But given the fact that their balance sheet is pretty strong and they're actually now becoming, once again, cash flow generative, even though we saw in the last quarter that not to be the case, I don't think that they're going to need to issue any more shares going forward. Once again, unless they take on a significant acquisition, for example, in which case, well, that isn't baked into my model anyway, and therefore I'm not taking the benefit of that, as in the benefit of growth, into my model as well. I then have a leverage ratio, which for this business, I'm using a current net debt to EBITDA, which is actually sitting at 4.6. So that's quite high. I'm expecting in 5 and 10 years from now, that will reduce significantly down to 1.5. The reason for that is because 1.5 is more in line with what they have historically been sitting at. And the reason why their debt is so high is, one, their parks have been shut, right? So they've had to incur a lot of costs without getting the income from that. And then also they've been making a lot of investments into Disney Plus. And then we come down to revenue growth, and for the 1 to 3 years, I'm looking at 15%, 4 to 5 years, I'm looking at 8%, and then 6 to 10 years, we're looking at 6%. So naturally, as the business gets bigger, it becomes more difficult for them to grow. If we look down to their historical revenue growth figures, 2017, they actually declined slightly by 1%, 2018 was 8%, 2019, 17%, and then of course they had the impact of COVID, and so their revenue declined by 6% and then increased again after that by 3%. Now, we have just seen them put in revenue growth of 34% for the quarter, but clearly that is not sustainable, right? The management have already come out and said that we've put in strong revenue growth because our comparables last year weren't very good. Simply put, their theme parks were closed, and as a result of that, their theme park revenue has doubled, and as a result of that, that's made their revenue growth look very, very good indeed. The reality of it is, though, is that for the full year, they're not going to see anything near 34% in revenue growth. So for 1 to 3 years, I'm looking at 15% revenue growth, which puts us to $102 billion of revenue by 2024. If I compare that to what analyst estimates are, we can go here 2024, and they're looking at around $102 billion. So it's pretty much right in line with what I have. We come here as well, we can see that analyst estimates for 2026 revenues are $116 billion. We come over here in 2026, I'm looking at $119.5 billion. So my estimates are slightly more bullish than analyst estimates, but it's roundabout in the same area. And that's one of the benefits of using TIKR Terminal. I can make a bunch of assumptions, and then I can have a look at what analysts think about the business and see how I align with those. If I see a huge discrepancy, then it makes me question whether my assumptions are actually correct, or whether analysts are actually missing something. We can then also see that for 2026, analysts are expecting revenue growth of 6%, which is pretty much right in line with my revenue growth for years 6 to 10 of 6% as well. So I think that my estimates are reasonable, and they certainly are in line with analysts. Now, in terms of gross margins, we can actually see that they have been declining over the historical period. So 46% in 2016, that actually dropped down to 40% by 2019, which by the way has nothing to do with COVID-19 because clearly that was before, but then we've fallen down to 33% in the last couple of years. Now there's a few reasons for that, right? We saw that their margins of their theme parks are actually higher, and therefore in these 2 years here where theme parks were closed for at least a portion of that time, that has had an impact on their margins. Not only that, they've been making a significant amount of investments in their Disney Plus business. I'm expecting that over the long term, they won't have to put as much cash into content creation, and as a result of that, their margins increase. So we can see here for my model, I'm expecting 38% margins in 2022, and that effectively increases right the way up to 45% gross margins. Now for operating expenses as a percentage of revenue, I've gone with the average of the last 6 years, which is 23%. We can see that the last couple of years was much higher than that, but I do expect that they'll be able to get to more reasonable levels, such as the ones where we saw sort of pre-2020. That means that we're expecting revenues to go from $67 billion in 2021 to $160 billion in 2031. Similarly, net profit going from $2.5 billion in 2021 to $28 billion in 2031. Now that does look massively distorted, right? But if we go and look at the 2019 figures, they were looking at $11 billion back in 2019 of net profit. We're expecting $28 billion in 2031. Now, in terms of the discounted cash flow, our weighted average cost of capital is 9%. When we look here at the EBITDA margins, we can see it was around 30% pre-2019. 2019 came around when they started investing heavily into Disney Plus. That fell off a cliff down to 23%, and then that fell off another cliff down to 14% and then 13% respectively. I'm expecting that EBITDA margin to effectively creep up back up to around 27%, where I think for this kind of business it will stabilize. And then in terms of unlevered free cash flow as a percentage of EBITDA, I've gone with a flat 60% across the period, which is slightly generous considering the fact that actually over the historical period, if we take out the 2019, which was an anomalous result, the average is around 51%. I do think that 60% for this type of business though, once their Disney Plus business has sort of optimized slightly, I do think that 60% is probably fair. That brings us to an intrinsic value per share according to the discounted cash flow of around $131, and we compare that to the multiple of earnings using an AP ratio in 10 years time of 18 or $121. We take the average of the two, we're looking at a fair value per share of around $126 for this business, which at the current price means that actually we're around 15% overpriced. Now in terms of the rationale for applying a PE ratio of 18, well, if we flick across the TIKR Terminal here, we can see that the average over the last 10 years has been around 31. So therefore you might be asking the question, well then why are you applying just a PE ratio of 18? Well, the simple answer is the fact that things got a little bit crazy here, right? So following COVID, the multiple went as high as 480. And the reason for that is because their profits absolutely sank because everything had to close, right? All of their parks had to close and therefore their profits went through the floor. If we take out COVID, because that's just not a fair reflection of the multiples that investors are willing to pay, we can see here that the average across the last 10 years or so, excluding COVID and all of the nonsense that brought about, 18 is the sort of average. And as a result of that, I think a PE ratio of 18 in 10 years time is probably fair. Now people might say, well, the business has changed since the last 10 years. They now have Disney Plus, which they didn't have previously. And as a result of that, the business should command a higher multiple. And I think that there is an argument for that. I still think that in 10 years time, despite the fact that they do have Disney Plus, I really don't expect this to be a fast growing business. As a result of that, I think a PE ratio of 18 in 10 years time is probably generous. We then come across to my 2026 price target for the business. We're looking at EBITDA of around $32 billion. I'm applying an enterprise value to EBITDA multiple of 14. The rationale for that is pretty much exactly the same as the rationale I used for the PE multiple, and we'll come on to that in a moment. We get a 2026 price target of around $222. Now in terms of the rationale for the enterprise value to EBITDA multiple of 14, well, we can see here that the average over the last 10 years has been 17. But once again, all of this over here, you know, an enterprise value to EBITDA multiple of 63 is not a fair representation of the business. If we actually take it back and ignore all of the significant reduction in profits that the business has seen and therefore elevated multiples, if we take that back, we can see an average of 12 over the last 10 years. I've applied a slight premium to that of 14, and as a result of that, I think that 14 is probably fair. So total annual return of 8.2% isn't bad, but it's not something that I would be interested in at the current prices. For me, Disney would have to fall a little bit further for me to really get interested. Anyway guys, I hope you've enjoyed the video, and until next time, thank you.